From Oaktree Capital Management wrote a short paper concerning the evaluation of performance records. It stems from Howard Marks, Oaktree's chairman, and his involvement with Pennsylvania University's investment board. Tonight we'll be reviewing some of the lessons learned over the last decade and why these are important to investors to understand. Gentlemen, a very big welcome to the show, of course. Great to have you with us as always. Kobe, let's kick off with you. Let's talk about this discussion regarding assessing performance. Firstly, let's kick off with a discussion around does the past matter and past performance. What are your thoughts on that?
I mean, I think, Samantha, firstly, I think past performance is certainly indicative of skill in the asset management arena, but you sometimes need to put that into context. You need to kind of understand where this kind of came from and what you needed to do in order to create some of these returns. I mean, certainly Howard Marks, when he writes from an Oaktree Capital Management perspective, and this is now in the United States, he kind of says, what have we learned over the last decade? What are some of the things that we need to take cognizance of when we look at returns, and what is kind of important? And I mean, if you look at the returns of the all-share index over the last 3 years, you'll basically see returns that look sometimes, well, pretty good and sometimes not so good. And there you can see it on your screen. Rolling 3-year returns for the all-share index. You know, sometimes you can get a return that looks kind of like up there at the 30% kind of mark. And sometimes the return, you know, like there, 45% rolling returns over 3 years. Everybody wants those kind of returns. But let's assume your experience has been somewhere down here. You know, the past does matter. It kind of makes it kind of what we feel about markets is our immediate kind of, you know, kind of response about how we kind of think about markets.
Roland, let's bring you into this discussion because, of course, it all has a context, and the context is when you measure the returns between what time frame you're looking at, what is the beginning point and what is the end point.
Well, typically in the industry, the norm is to use 3-year periods. So fund managers and funds in general are assessed over a 3-year period. The irony in the industry, which is sort of makes a lot of people uncomfortable, is that the fact that there's no scientific research to show that past performance actually does indicate future performance. So if a fund has done well, or if an asset class or a sector has done well, it doesn't necessarily show much persistence in the long run. So that is something we have to deal with, and obviously when we're picking managers or investments, we have to take cognizance that these things don't last. So whatever fund you choose, whatever strategy you're invested in, will not last forever. So there's a new category of research that actually has come to the fore now called, goes under the strange name of alpha budgeting, and basically what that does is it looks at analyzing under what market conditions active management is more effective than under other market conditions. So to give an example, when stocks are highly correlated, it is very difficult to do stock picking, because if all stocks are going up and down by the same amount, then the ability to add value as an active manager is much less so than in other periods. So people are now starting to look at market behavior and adjust their strategy accordingly. But there isn't, unfortunately, a strategy, even with a long track record, that will continue to do well forever.
Yeah, I mean, if you kind of listen to what Roland is saying there, I mean, Roland is talking about education. He's talking about how do you educate people at the end of the day. And I mean, that's different for individuals to boards of trustees. And I mean, in this case, we're talking about kind of a university board and how they make decisions.
So you would understand
as far as returns are concerned.
The defensive nature of that.
Yeah,
what context does that have for those who are investing in certain funds?
Well, I mean, again, I think that there's risks that are assumed, that you assume with certain funds, and making use of things that are much more high growth within the right capital cycles can certainly add huge amounts of value. You know, if you look at people how they invest money, often they say we don't want to lose money. You know, we want to only make money. We don't want to lose money. But part and parcel of the capital cycle is the fact that you can gain money, but you can also lose. And the fact is, if you just so conservatively invest it, you can never create the gains. And the question is, at what point do you create those gains? Now, it's quite interesting, because if you're sitting with an individual, Roland, that has gone through major trauma in the market, they've lost money, you need to go through like a re-education program. You need to actually sit down and you need to take them through the tools, and you need to be able to show them what it is that what is it they need to be focusing on, rather than kind of just looking at the event and saying, well, this is, you know, terrible. I mean, have you had experience with that?
Well, I think it's a bit too late, perhaps, after they've had the returns to try and re-educate them. But we need to always, when we advise people on what investments they're going to take, beforehand what the risks are. In fact, the risks are quite stable. We can pretty much estimate, we don't know when the markets are going to misbehave, but we certainly know on average what the volatility of the market is, or the bond market, or foreign investments. What we don't know is what the return is going to be. So the risks are actually quite reliable. And,
so how do you set the expectations?
Well, what you got to do
clients?
is you got to explain, what is your downside. Most people are much more worried about the downside than the upside. So if we can explain to people that, are you happy over the next 5 years that there is a chance that you might have minus 20% or whatever the 1 or 2 standard deviation event is that you're trying to explain to clients, that gives them a very hard number to consider. Am I needing this money to buy a house? Am I needing this money to retire? Am I needing this money just because I want to have a return? Those are all issues that need to be taken into account. But we talked about track record just now. It's very important to understand that the asset classes such as cash, bonds, equity, property, offshore investing have got the longest track record in the world. They go back 100 years, right? A fund manager's track record on average is about 3 years. Most fund managers change the fund they manage on average by every 3 years. So
yeah.
The most reliable track record is actually what the markets have done. So we should look at those first before we pick managers.
Exactly the point, Kobie, just in terms of looking at that time point that you assess the manager with.
Yeah, I mean, again, I think, and Roland is pointing to that, kind of understanding the time frame and what are some of the tools that the manager could utilize within that time frame becomes really, really important. So, I mean, again, here, Howard Marks makes the point that you need to judge performance in downward cycles and upward cycles. And I want to come back to what Roland said just now, because he spoke about what is the worst volatility that you could potentially take into consideration in the market. And we utilize something in the industry called drawdown analysis. Look at your screen and you'll see drawdown analysis happening. There's the all-share index, and that's the worst drawdown that you could have had for the all-share index since 1999. Now, just to kind of put clarity to this is from a high point the market achieves, what is the worst that it can drop? So if you go back to that 08-09 event, there's a subprime crisis, you can see the total drawdown from the top end of the market. I mean, fairly high. There's 02, the crisis of 02, that's on the back end of 9/11 in 2001, and you can see the drawdown there. Is that part and parcel, and this is the question, is this part and parcel of what you want to experience? Because it does happen, and it happens roughly every 5 to 10 years. Are you happy achieving this? Are you happy experiencing this?
So you have to ask your fund manager, what is their drawdown? How much money, what is worst case scenario in terms of how much money you're going to lose, basically?
Yeah, absolutely. And then, I mean, Roland, not just only that, but it's also within part and parcel in a diversified portfolio of assets, because it's not just necessarily equities you're going to own, there's a whole bunch of other asset classes. And I mean, drawdowns look different for different asset classes. And I mean, have you got any thoughts around, any new work has been done around correlations and volatilities for multi-asset class type portfolios?
Yeah, the latest sort of the latest scenario at the moment is that most asset classes seem to be quite highly correlated. This doesn't help when it comes to diversification. We try and diversify across as many asset classes as possible to minimize the depth and the duration of those drawdowns. The graph Kobie just showed you, he highlighted the depth of it, but you could also see the duration of those drawdowns, and they typically can last between 3 to 10 years. In some markets, it takes 10 years like in the US, it's taken 10 years for the S&P 500 to get back to where it was previously. So that kind of pain threshold is not only the depth, but how long is it going to take for me to get out of that hole that I'm in. Now, these things don't happen often, but when they do happen, they're quite deep. So the only way to really protect yourself in advance is twofold. There's general diversification across as many asset classes as possible, and they must be uncorrelated. At the moment, they are not, so the risks are actually higher.
That is the question. So has the world changed? Because we've seen bonds performing well and equities performing well.
Well, we're seeing since the subprime crisis that most things are highly correlated, and that's not normal. We don't know when that is going to unwind itself again, but we even see within asset classes for example, if you take the dollar and commodities are very highly correlated. The dollar and commodities in the past never were highly correlated. So we're in this risk-on, risk-off kind of environment where everything is highly correlated. And if you pull on one thing, all the other variables change at the same time in either the same or opposite directions. Now, when we're trying to diversify, we'd like uncorrelated things, which means they can go anywhere relative to each other. and we're not seeing that. So I would expect, sort of from a statistical perspective, that if for 40 years things were pretty uncorrelated and now they're highly correlated, that that's going to at some point break down. And I think that that would happen once the fears around Greece and the sort of the whole global financial crisis and the sort of Chinese soft landing and these kind of issues, once that's out of the way, you're going to start the market seeing normalizing again.
But now that you see, the interesting question now, Samantha, is you're the client. Okay, think about it from a client perspective. You're the client and you're trying to plan within these constraints. You're trying to understand how you need to invest money. Do you see how complex these things become? And it becomes kind of completely removed from kind of the day-to-day operations of the market, and it becomes much more kind of around the philosophical and the process kind of orientated issues. And that's kind of what drives asset allocation at the end of the day.
So when you're looking at a fund manager, do you go for one that has that balanced approach all the time? Do you go for one that is flexible and able to change the portfolio, basically responsive? Or do you go for one that sticks to the core principles no matter what's taking place in the market?
Yeah, I mean, and I think Roland will bear me out here. I think all three of those factors are important. I don't think there's any one of those that are more important than the other one. Because I think that, you know, a manager has to be agile enough in order to make the changes that are necessary in order to ensure that the portfolios achieve what they should be achieving, but also need to be able to be process oriented so that they can make sure that the philosophy is kind of applied and consistently over time. And then I suppose there's a third or fourth element, if I had to add to your three, and that is the client's ability to kind of stay through thick and thin. Because not everything is always going to win. Not all fund managers always do well, but staying with the strategy and ensuring that you do so over time usually bears the fruit. We always make the industry, I mean, industry always talks about, Roland, about the fact that, you know, investments succeed, but investors fail. Is that not true?
Absolutely. I do think that when you are choosing a fund or a strategy in terms of the asset allocation, one has to try and, again, tailor-make that decision to what your needs are. So if you need a return on your investment that needs to be very safe, you need a return to fund a house or something important, you don't want to go with somebody who's going to take on a lot of risk or can change the portfolio suddenly. You want a slow-moving kind of investment, which would be the much more balanced fund manager rather than a flexible fund manager. If you want a higher return and higher risk, then you go for an asset manager that makes quite radical changes to the asset allocation. I don't think many fund managers anticipate necessarily what's happening in the market. Certainly the evidence or the research that we've done shows that most of us, and it includes stockbroking analysts, fund managers, all of us tend to react more than we anticipate things. But there are certain things that one can do in terms of preserving capital.
But you don't want a reactive fund manager, that's the point. Surely not.
From a cost perspective, you're right. You don't want a fund manager churning around and then just not really, trying to market time, and that's clearly quite tricky. And in the long run, those funds probably don't do that well. So you want a strategic manager that does position it. But if I want a high return over the next 2 years, I don't want a slow-moving tortoise kind of asset allocation. I want the rabbit fund manager who's going to try and do his best. Obviously, my faith will have to be in whether he's going to deliver that or not. But if I'm looking for a long-term retirement investment, then obviously I want the slow tortoise approach, which will get me there in the end, but it won't be with sort of the risks associated with other strategies.
I think Roland's starting to touch on quite an interesting topic here, because he's saying that, you know, depending on the strategy that you choose, it's actually about expectations. And by the way, that's one of the lessons that you learn by reading this paper. Expectations matter. What you do with your money is very important. What you want to achieve with your money is very important. And I mean, often a very good framework for doing so and for actually building up these expectations is by using the thing that's on your screen at the moment. And you'll see that it starts off by asking, what is the investment objective? And often this investment objective needs to be linked to a lifestyle event, or it needs to be linked specifically to a liability. Do you need to keep a whole bunch of kids at university? Yes or no? Do you need to retire? What is that event? What is that, and how does that relate to an investment objective? Once you understand that, you can start thinking about portfolio construction. How much equities, how much bonds, how much cash on average? Should you be underweight? Should you be overweight? What are some of the things that you need to be thinking about? And then, only thirdly, what is the risk that is assumed with it? We always started in the past by thinking about risk. we always say to the client, what kind of risk would you want to take? And you gave people that questionnaire. Do you like bungee jumping? Do you like, do you like falling out of planes? Are you not scared? You're a risky investor. Put all your money in equities. Those things don't actually tell you anything about investment objectives. And that's why investment objectives are so important, understanding.
What does this mean about assessing returns? So basically it all boils down to what your returns are. You invest money with a fund manager to make money. So how do you assess returns, bottom line?
Well, bottom line, if you're getting 10%, or the number that you're getting at 10% at the end of the day, is that good or bad? Well, you'll only know that if it's achieved your objective or not. And that's through thick and thin, down cycles and up cycles.
Roland, your views?
I think if you should always start off with the asset classes. So you can pretty reliably estimate that over a 5-year or longer period, you are going to get a return probably over 10 to 15% from equities. The equity returns have averaged that in the long run. So we know that, we can bank that. We don't need to hire a fund manager to do that. We know that bonds will have a slightly lower return for slightly less risk, and cash obviously doesn't have inflation beating capabilities necessarily, so one has to be careful putting all your money in cash. Only if you have a short-term horizon do you want to have a lot of money in cash. But once you've allocated to those risk buckets, then you need to decide which fund manager you want to hire and who's going to try and beat that benchmark. But that is the cream on the top, is trying to get the fund manager who can give you that extra bit. The main returns will come from the asset classes or the sectors that your fund is exposed.